Hello everyone. Please confirm if the audio and video is clear to everyone. Can you please confirm if the audio and video is clear to each and every one? Wonderful, wonderful, wonderful. So I believe all of you have your examinations in the upcoming week, that is 5th of December, and I am here. So what I have done here is I have taken up the important and the critical questions. Okay, important and the critical questions which are there in BPP or Kaplan or mock exams, okay, or ACCA study hub. So whatever are the critical or the most important questions or the questions where I think on the basis of my experience where you can make mistakes in the exam, I have selected those questions and I have brought in for you, and I'll discuss those questions with you in detail. And I believe all of you will enjoy the session. But tell me one thing, you are watching the session without liking it, is it correct? Watching the session without liking it. So all of you, first of all, hit the like button. First of all, hit the like button. Come on, guys, all of you. First of all, hit the like button, all of you. Okay. Now, one more thing before we start the session. See, in this session, I will be helping you with the questions, okay, and I will discuss everything, okay, as if I'm taking the regular session. I will discuss each and everything. But see guys, understand, if you have not revised your syllabus or if you need help in the revision, so what you have to do, you have to come to my YouTube channel by the name CA Vishal Jain. Don't come in the video section, otherwise you will get confused, okay, because here you will find the video of ACCA FR, ACCA SBR, CA Final FR. So directly come to the playlist section. See what I have done for you. I have made a simple clear-cut playlist for all of you. I have made a clear-cut playlist for all of you ACCA FR, wherein all the videos for your relevant for your exam can be found here. All the videos, be it the entire revision of ACCA FR in just 8 hours, be it super 30 questions, be it exam technique, be it other important mistakes which you have to avoid, okay, be it sustainability standards, everything is here in one playlist, okay. So refer this playlist. Now, one more thing. In this super 30 questions today, which I'll discuss, I will be discussing all the chapters except for group accounting. Sir, why? Because group accounting super 15 questions is already you can find here. See this video. In this video, see group accounting question practice. So all the important questions from the point of view of group accounting, that is super 15 questions, I have already discussed. So you can find here FR revisions group accounting question practice. So you can find it here. Okay. So refer this one. I believe it is very much clear to all of you. Can you please confirm, guys? Can you please confirm if it is clear to all of you now? Wonderful. Wonderful. Now coming to the super 30 questions, one by one, chapter by chapter. So first one is non-current tangible assets. Guys, only one request, don't lose out on your patience today. Watch this session till the end. If you really want to pass the exam, I'm telling you from now itself, please watch the session from the start till the end, every single minute. Don't leave the session. We will spend 2 hours. And I'll tell you that every minute of this session will be beneficial for you. Okay. So now understand. So first question is non-current tangible assets, and this question is from the borrowing cost. Now generally what I have seen is students are struggling. What is the amount of borrowing cost to be capitalized if it is a general borrowing or if it is a specific borrowing? So now let us clear out this confusion. Once for all. Now understand what is this question talking about. Gilbert Company took a 7.5 million loan, 10% loan on 1st January 20x6. to build a new warehouse during the year. The construction of the warehouse began on 1st February 2006 and was completed on 30th November 2006. Now understand what happened. We have taken loan on 1st January 2006, but we started the construction on 1st Feb 2006. Now comes the question, will we start the capitalization of borrowing cost from 1st January or 1st February? Now coming to IAS 23 on borrowing cost. It says we have to start the capitalization of borrowing cost when the three condition gets satisfied. What are the three conditions? Expenditure starts to get incurred, borrowing cost is incurred, and construction activities has started. So understand, since I have taken a loan here, definitely my borrowing cost starts to get incurred. Okay, but is the construction activity started? Tell me, has the construction activity started? No. So construction started from here. So we'll start capitalization of the borrowing cost from this date. So now whatever borrowing cost we incur in this period, whatever borrowing cost we incur in this period will be transferred to P and L. Okay, will be transferred to P and L. Now, since this is a case of specific borrowing, why specific borrowing? Because we have taken a loan, to build a new warehouse. So this borrowing is a specific borrowing. So what we will do? What will we do? So in case of specific borrowing, we capitalize the actual borrowing cost incurred. We capitalize the actual borrowing cost incurred during the period of capitalization. Actual borrowing cost incurred during the period of capitalization. Now, this is your period of capitalization. On this date, the construction activity starts and construction activity ends on 30th November 2006. Construction activity ends on this date. So this is the period when the construction activity ends, and this is called as your period of capitalization. So all the borrowing cost incurred in this period will be capitalized to the cost of the asset. Now, what is the loan that I have taken? 7.5 million is the loan that I have taken. What is the rate of interest of the loan? 10%. 10%. Now, what is the month from 1st February till 30th November? That is 10 months. 10 months. So 0.625 is the amount of borrowing cost to be capitalized. But understand, wait. Now the question also says Gilbert Company invested 2 million in 4.5% bonds from 1st January to 1st May. Now understand, from 1st January to 1st February, did we capitalize the borrowing cost? No. So if we receive any investment income in this period, will we capitalize it? Will we adjust to the cost of the asset? No. So any borrowing cost incurred in this period or any investment income earned in this period, both will be transferred to P and L. Now, borrowing cost incurred in this period, actual, whether we utilize the funds or not, actual borrowing cost incurred in this period is capitalized, and investment income earned in this period, okay, that is, sorry, from when the construction started from 1st February till 1st of May, will be reduced from the cost of the asset. So this is what you will capitalize. And 2 million at the rate of 4.5%. Why 3 by 12? Because we'll start from 1st February till 1st May. So February, March, April. Okay, February, March, 1st February to 1st May. Okay, so it becomes how much? Feb, March, April. Okay, 1st May, right? Feb, March, April. Yes, 3 months. Feb, March, April. 3 months. Okay, so we have taken 3 months. So this comes to this much, which will reduce from the borrowing cost, and this is the amount of borrowing cost which will capitalize. Now again, even if you come to this answer, your answer will be wrong. Why? Because you need to understand, because the question is asking what? It is just written a dash. See the requirement, it is just written a dash. So you have to write your answer in absolute figures. If any students write here and answer as 0.6025 million, you will be awarded with 0 marks. You will be awarded with 0 marks. So what you have to write? You have to write the answer in absolute figures. Sir, how to determine when to write the numbers, answers in absolute figures, when to write your answers in millions or thousands? So for that, again, I have made up a detailed video, not much lengthy, small video only. See, here it is. You will find one video on section A and section B, the trick to write the answer. Okay, so you will find that video. Just watch that video. It will be there in this playlist itself. Watch that video. In that video, I've clearly explained when you have to write your answer in absolute figures, when to write your answer in thousands. Okay, everything is given there. Everything is given there. So make use of that video. Okay, if you want, I will give the link of that video in the description box also. Now, coming to the next question, intangible assets. Which of the following cannot be recognized as intangible non-current asset in GHK's console statement of financial position? Now understand. Okay, Lucky has a query. Sir, in condition where there is a year end or a problem where the construction was stopped for a while, so in that case we will stop capitalizing the borrowing cost for that period. Okay. Now, which of the following cannot be recognized as intangible asset, non-current asset in GHK's console FS? Now understand, the question is saying console FS. Read the question carefully. Console FS, console SOFP. Now understand, let's read these points. GHK spent 132,000 developing a new type of product. In June 20x1, management was worried that it would be too expensive to fund the finances to complete the project from a cash injection from a benefactor received in November 20x1. Okay, so basically by year end, we wanted to make a product, but it was expensive, so we didn't have the resources. Okay, so if we don't have the resources, can we capitalize that? No. Why? Understand, you remember, for entering into the development phase, PI rate has to be satisfied. What is the meaning of PI rate? Probable future economic benefits. I means intention to complete. R means resources to complete. So now in this case, in the case A, we don't have the resources to complete. Okay, so hence we will not be able to capitalize this. Okay. Now, recording of this won't be made available. So now the question says cannot be recognized. So now the answer is A. But won't we read others? Let's read once. GHK purchased a subsidiary during the fair value exercise. It was found out the subsidiary has a brand name with an estimated value of 50,000, but that had not been recognized in the subsidiary as it was internally generated. So as we know, in case of group accounting, we do recognize the brand name of subsidiary at the fair value on date of acquisition. So it will be recognized. GHK has a brand name from GHK purchased a brand name. So if it is purchased, definitely we will recognize. GHK spent 21,000 during the year on development of a new product. After the management concluded it would be viable and management has already spent, so we'll capitalize. So these three will be recognized as intangible asset. Only option number A will not be recognized. Okay, now moving on to the third part. Guys, tell me, are you understanding where you could have made mistakes in the exam? Are you understanding, guys? Everyone, come on, guys, please tell me. Everyone, tell me, are you understanding where you could have made mistake in the exam? Wonderful. Now coming to the third question. AMCO company carries out research and development. Okay, in the year ended 30th June 20x5, AMCO company incurred total cost in relation to the project of 750,000, spending the same amount each month up to 30th April 20x5 when the project was completed. The product produced by the project went on sale from 31st May 20x5. The project has been confirmed as feasible on 1st January 20x5 and the product produced by the project expected to have a useful life of 5 years. Question is, what is the carrying amount of the development expenditure asset as at 30th June 20x5? So first of all, understand the question. So the question says that during the year ended 30th June 20x5, we have incurred an amount of 750,000 till 30th April 20x5. So meaning thereby starting from 1st July 20x4 till 30th April 20x5, we have spent an amount of 750,000 over this 10 months. We have spent an amount of 750,000 over this period of 10 months. So now tell me, what is the expenditure per month? That is 75,000. How can you say that? Because see, the question is saying here, see, spending the same amount each month. Spending the same amount each month. So the expenditure per month is 75,000. Now the question says that project has been confirmed feasible on 1st January 2005, meaning thereby before 1st January 2005, it was into research phase. And it is from 1st January 2005, it enters into development phase. It enters into development phase. Now, so whatever expenditure that we do in research phase is recognized in P and L. We don't capitalize the same. But whatever expenditure that we do in development phase, we capitalize the same. So whatever expenditure we'll do from 1st January till 30th April, that is January, February, March, April, 4 months. So 4 months, 75,000 is equals to 300,000. 4 months, 75,000 per month is equals to 300,000. So this is what we will capitalize as on 30th April. But now, what is the question asking for? What is the question asking for? The question is asking what is the carrying amount on 30th June 2005. What is the carrying amount on 30th June 2005? Now I will have to explain this point. So listen to me very carefully, my dear friends. So now I have always told in my regular class, for any internally generated intangible asset, it is divided into 3 phases. First phase is called as the research phase, wherein all the amount that we spend goes on to P and L. Second phase is called as development phase, where we are developing the asset. Herein all the amount that we spend is capitalized. But do we amortize? Do we amortize? No, we don't amortize. No, we don't amortize. Now, once the product enters into developed phase, we start to amortize. Okay. Now, so what we have done, we have capitalized an amount of 300,000 in the development phase. Product went into developed phase from what date? 31st May 20x5. 31st May 20x5, product went into the developed phase. Now from 31st May, we will start amortizing the asset. From 31st May, we will start amortizing the asset. Now, till over 5 years. So what is the amortization? 300,000 divided by 5 years. Now for how many months? We have to calculate the carrying amount on 30th June. We have to calculate the carrying amount on 30th June. So from 31st May till 30th June is 1 month. Okay, so we will amortize it for 1 month. That comes to 5,000. So 300,000 minus 5,000 is 295,000 is the answer. So your answer is 295,000. I believe you are understanding these points. I believe you are understanding, and we are discussing each of these points in much depth. We are discussing each of these questions in much depth. Okay. Now coming to the next question. Sagan company acquired a brand name. This is a wonderful question, and I tell you, if a question like this comes in the exam, I can guarantee that you will make a mistake in this question. Understand? Sagan company acquired a brand name, estimated useful life of 10 years on 1st January 20x2 for 10 million. So basically the question is saying on 1st January 20x2, brand name has a cost of 10 million. Life is 10 years. So definitely we are amortizing the brand name by 1 million per year, which we purchased on 1st January 20x2. Now on 1st January 20x5, a brand, okay, 1st January 20x5, first of all, tell me what is the carrying amount. So we are amortizing it by 1 million per year. So from 1st January 20x2 to 1st January 20x5, if we go, so 20x2, x3, x4, 3 years, right? Hence we reach 1st January 20x5. So we have to amortize it for 3 years. So 1 million into 3 is 3 million. So what 10 million minus 3 million is 7 million is the carrying amount. 7 million is the carrying amount. Very good, Nimita. Now, Now, so now the question says that on 1st January 2005, a brand specialist believed that the brand to have a fair value of 14 million. So now the question is saying the fair value of the brand is 14 million. Okay. Sagan company also ran a training course on 1st January 2005 for all staff on how to use a new software system. The training cost Sagan company 450,000. On average, the employees are expected to remain with Sagan company for 3 years. How much should be recognized as an expense in statement of P&L for our brand amortization? So understand, what was the brand value? What was the brand value? Carrying amount was 7 million. Fair value is 14 million. Life was 10 years, but we have already used it for 3 years. So the remaining life is 7 years. Fair value is 14 million. So can I say my amortization will be equals to 2 million? Can I say my amortization will be equals to 2 million? Let me see who are active in the class. Come on, guys. I need answer from each one of you. I need answer from each one. If you tell me, can I say that the brand amortization will be equals to 2 million? Why? 14 million is the fair value. 14 million is the fair value. Life is 7 years. So 14 by 7 is 2 million. So my dear friends, I am excited to state that your answer is wrong. Brand amortization will not be equals to 2 million. No, 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 no. Why? If you can go back to IAS 38 intangible assets, the intangible assets clearly says that we can adopt revaluation model of an intangible asset only if it has an active market. Now tell me, what is the meaning of active market? What is the meaning of active market? Active market means it is being traded in the open market with sufficient volume and frequency. Now tell me, do you think brand name has an active market? No, brand name doesn't have an active market. So what will we do? Can we keep the brand at fair value? No, we can't keep brand at fair value. So brand will be kept at cost only. Brand will be kept at cost model only. We cannot apply revaluation model to brand name. So what will be the amortization? So fair value is not relevant here. Okay, the question is testing whether you know the provisions of IAS 38 that revaluation model is applied to intangible asset only if it has an active market. Okay, it has an active market. Like for example, I have the license of Oracle. It does have an active market, okay, but brand name does not have active market. So the brand amortization will be 7 million by 7 years is equals to 1 million. Now training cost, as I have already told, that training cost to staff is not in my control, okay, So whatever amount that we incur as training cost is not capitalized, is never capitalized. It is always transferred to P and L as and when it is incurred, okay. So now 7,450. So training cost or 450,000 will be transferred to P&L. Is that clear to all of you? Tell me guys, come on. Now, impairment of asset. Guys, come on, please tell me, are you understanding these points? See, so far we have already solved 5 questions. Out of 30, we have solved 5 questions. Come on, guys. We need to pace up now. A division of the entity has the following balances in the financial statements: goodwill, plant, building, intangible assets, other net assets. Following a period of losses, can you tell me the total carrying amount? Tell me the total carrying amount? Where is my calculator? Here it is. So total carrying amount is 700 plus 950 plus 2300 plus 800 plus 430. Total carrying amount is 5180. Following a period of losses, the recoverable amount of division is happened to be 4 million. So what is the impairment loss? 1180. How will you allocate the impairment loss? First of all, to goodwill, how much? 700. Now what is remaining? 480. This you will allocate to which one? So goodwill is already impaired now. So remaining are plant, building, and intangibles, because other net assets we cannot impair. Why? Because on that impairment rule won't be applicable. Okay. So now understand. It says a recent valuation of the building. Showed that building has a market value of 2.5 million. Now tell me, can I impair building now? Can I impair building? No. Why? Because it says the carrying amount of the building is 2.3, but the fair value of the building is 2.5. This proves that we cannot impair building. So we have to allocate this 480 to plant and intangible asset in the ratio of their carrying amount, and there is no impairment loss that will be allocated to building. Okay, now what is the question? To the nearest 1000, what is the balance of building following the impairment review? The same, 2300. Is that clear, everyone? Wonderful. Now moving on to the next question. Metric owns an item of plant which has a carrying amount of 248,000 as at 1st April 20x3. It is being depreciated at 12.5% per annum on a reducing balance basis. Okay, the plant is used to manufacture a specific product which has been suffering a slow decline in sales. So basically the question is saying that I had a plant which had a carrying amount of itna on 1st April 20x3. It is being depreciated at the rate of 12.5% per annum on reducing balance basis. The plant is used to manufacture a specific product which has been suffering a slow decline in sales. The metric has estimated the plant will be retired from use on 31st March 20x7. Now it means there is an impairment indicator. The estimated net cash flows from the use of the plant and their present values are this much. So this is your value in use. Okay, now on 1st April 20x4, Metric had an offer from the rival to purchase the plant for this much. So this is your fair value less cost to disposal. So now you know the recoverable amount. So recoverable amount will be higher of these two. That is, recoverable amount will be 214,600. But now what you need is the carrying amount on 31st March 20x4. So now the carrying amount on 31st March 20x3 is 248,000. We will have to depreciate at the rate of 12.5% WDV. So hence the carrying amount happens to be 217,000. Your recoverable amount is this much. Since your recoverable amount is lower than the carrying amount, you will bring the value of the asset down to the recoverable amount, and this decrease in the value of the asset is called as impairment loss. Now what is the question? At what value should the plant appear? Revised carrying amount will be 214,600 because the value of the asset will decrease by 2,400 and it will become 214,600. Okay. So it will become 214,600. Come on guys, tell me, are you understanding this point? Guys, no need to write anything. I will be sharing this PDF with you. Okay. So to get this PDF, you have to join my Telegram. In the Telegram, you will find this PDF within 1 hour after the session ends. Okay. Now, again, see, this is a question. This is a very simple question of impairment. Okay. So this is a very simple question of impairment wherein the carrying amount at the beginning of the year is given. Okay. Now, at the end of year, we have to test it for impairment. So first of all, we have to calculate the carrying amount at the rate by depreciating the asset at the rate of 12.5% per annum on reducing balance. So this is what is the carrying amount. Now we have to calculate the recoverable amount. As we know, recoverable amount is higher of value in use and fair value less cost to disposal. value in use and fair value less cost to disposal. So what is the value in use? Present value of the future cash flows. So what is the present value of the future cash flows? 214,600. So that is 214,600. What is fair value less cost to disposal? What is fair value less cost to disposal? Fair value less cost to disposal is what is the value if I sell the asset, that is given at 200,000. So what is the higher of these two? 214,600. What is the higher of these two? 214,600. So this is the recoverable amount, this is the carrying amount. Since the asset is not fully recoverable, we will bring the value of the asset down to its recoverable amount, and this difference is called as impairment loss. So carrying amount minus impairment loss is your revised carrying amount, 214,600. Okay. Now coming to the next chapter, that is non-current assets held for sale and discontinued operation, that is coming up from a chapter of or a standard of IFRS 5. IFRS 5. Now I have seen students are struggling in understanding what is the meaning of non-current asset held for sale. So first of all I will explain that meaning. So understand, let's suppose I am using a laptop. Okay, for taking my classes. I am using a laptop for taking my classes. Now I already used it for 2 years, but now I believe that this laptop is not useful for me and I just want to sell the laptop. I want to dispose the laptop. I want to sell the laptop. Okay, now it is called as held for sale. Okay, but understand, I purchased a laptop to sell in the ordinary course of business because it's my business to sell laptop. It is called as inventory. So you need to understand the difference between what is a inventory and what is a non-current asset held for sale. Both are different things. Vedika, don't worry, I will explain that part also when I will come to the chapter of provisions. Do remind me when I will come to chapter of provisions today. Do remind me, Vedika, I will take up your point. Okay. Now understand. So what is this question? On 1st April 20x4, Tilly owned a property with a carrying amount of 800,000 which had a remaining estimated life of 16 years and was carried under a cost model. On 1st October 20x4, Tilly decided to sell the property and correctly classified it as being held for sale. A property agent reported that the fair value less cost to sell at 1st October 20x4 was expected to be 790,500, which had not changed at 31st March 2005. So let us understand the question first of all. So the question is saying on 1st April 2004, okay, the carrying amount of the property is 800,000. And a remaining life of 16 years. Okay, now further on 1st October 2004, Tilly decided to sell the property. So here it is classified as held for sale. Okay, now understand. So first of all, I will have to depreciate the asset from here to here, that is 800,000 by 16 years. For half year, that is 25,000. So my carrying amount on this date is 775,000, that is 8 lakh minus 25,000 comes to 775,000. Okay, now the question is saying on this date the fair value less cost to sell is 790,500. Now, as per the provisions of IFRS 5, non-current asset held for sale, we have to recognize the asset at lower of the carrying amount and fair value less cost to sell. So what is the lower amount? 775,000. So the carrying amount is 775,000 on this date. Now, again, now tell me, in this period, will we depreciate the asset? No, I will not be depreciating the asset. As per the provisions of IFRS 5. Okay, now, so we have recorded here at lower of these two. So now understand. So this becomes the carrying amount as on this date also becomes 775,000. Now what is the fair value less cost to disposal here? So it says the fair value less cost to disposal on 1st October and 31st March remains the same. So it will become 790,500. So again we will have to account for it lower. So lower is 775. So what is the carrying amount here? 775,000. So what is the question now requirement? What should be the carrying amount of property in Tilly's SOFP at 31st March 2005? The answer is 775,000. The answer is 775,000. Tell me, is that clear everyone? Question number 4. Sorry, this question is clear. Is this question clear to everyone? Very good, Vedika. Very good, Vedika. So basically, in this period, no depreciation, no revaluation as per IAS 16 or 38, and no impairment as per IAS 36 impairment. No depreciation, no revaluation, no impairment when the asset is classified as held for sale. Okay, after the asset is classified as held for sale, we do not depreciate, we do not revalue, we do not impair as per IAS 36. Okay, now comes to the next chapter, that is leases. But before we move on to the leases, come on guys, tell me, you have to give me a confirmation. Is everything clear? Is everything clear to you? Are you understanding? Is this session helpful? Come on guys, tell me. All of you, give me a thumbs up. Are you understanding everything? Session is helpful? Are you getting to know where you could have made mistakes in the exam? Wonderful. Okay, so now let us proceed further. During the year ended 30th September 2009, Hyper entered into two lease transactions. On 1st October 2008, Hyper made a payment of 90,000, being the first of the 5 equal annual payments under a lease for an item of plant. The lease has an implicit interest rate of 10%. The present value of the total lease payment in 1st October 2008 is 340,000. I will tell you, this is very important question. Generally, students will make a mistake here. Multiple type of mistakes they will make. I will explain you. Can you tell me on yourself, in this case, lease payments are being made in advance or arrears? Lease payment are made in advance or arrears? Tell me. Lease payments are made in arrear or advance? Point is, it is made in advance. How come? See, on 1st October 2008, it made a payment of 90,000, being the first of the 5 equal annual payments. Meaning thereby what? I started the lease today and I made the first payment also today. So means the lease payment are in advance. Now, so it means that what is for how many terms? 5. 1, 2, 3, 4, 5. This 4. Okay. 5. Now, so every year beginning, I have to pay 90. Okay. Now, here I will have to calculate lease liability as the present value of these. Okay. Now tell me, the present value is given. The present value of the total lease payment was 340,000. Now tell me, this 340,000 is is the present value of all 5 or only these 4? This 340 is the present value of all 5 or only these 4? Tell me. It is the present value of all 5. Why? Because the question is saying total lease payments. So here you have to understand the term. Total lease payments means it includes this 90 also. But if the question would have said future lease payments, means only these 4. Are you understanding this point? Mr. Lucky and Sadavrat, are you understanding these points? Because you too made a mistake here. Are you understanding this point? So if the question would have said future lease payment, it means it would have meant only these 4. Okay. Now, once I have said only these four, then don't make a mistake here. I will explain here. Understand? Just a minute. I will take up some additional responsibility for you guys. If the lease payment are in advance, if the lease payment are in advance, and so it means, understand, 1 2 3 4 5 guys, I'm explaining something out of the box, something out of the question, so please listen to me carefully. 90 90 90 90 90. Question says total lease payment, it means all 5. Question says future lease payments, means next 4, next 4, next 4. Now, but if the question is, copy, paste. But if the question is that the lease payment are made in arrears, not advance. The lease payment are made in arrears, not advance. So in that case, I will remove 90 and I'll put 90 here. The question says total lease payment, then also all 5, and the question says future lease payments, then also all 5. Are you understanding this point? Are you understanding this point? So see, understand, one small word, total and future, but the difference is significant. Your total answer will change. So you have to make a note of this point. You have to make a note of this point. So this question ideally looked quite very much easy, but I believe I can guarantee that none of you would have identified or realized that this, how important is this point. Are you understanding this point, all of you? Come on guys, tell me. Are you understanding this point? So now you have to make a promise. I promise that I will not make this mistake in the exam. Come on, all of you, come on, come on, come on. If present value is before the initial lease payment, then what will be the treatment? Understand, Vedika. I will explain that part also. No need to worry. No need to worry, Vedika. If VJ is here, the tension of FR is gone. So understand, how will it make the difference? How will it make the difference if the question says total lease payment or future lease payments? Now the question will ask you, let's suppose the requirement of the question is calculate finance cost of this, and the present value is 340, present value is 340. Okay, let's suppose present value is 340. Now if the question says total lease payments, you know what you will do? First of all, out of this you will pay 90, and then you will calculate 10%, and to calculate finance cost, that is 25,000. But if it says future lease payments, it means this 340 is for this much only. So it means it is after payment of 90. So now, are we required to do minus 90 here now? No, I am not required to do minus 90. Why? Because it is excluding 90. We have already paid 90. Okay. Now multiplied by 10%, it is equals to 34,000. Are you understanding it? Are you understanding it? Tell me guys, come on. Are you understanding it? Vedika, is your doubt clear? That's what I'm explaining, Gaurang. That's what I'm explaining. Advance. Vedika, can you please confirm if your doubt is clear? Okay. Now, coming back to my question. Since it says total lease payment, it means It means it is including 90,000. So hence I will first of all reduce 90,000. Why? Because it is not my lease liability, because it is already paid. It is already paid. It is already paid. So minus 90, my liability is this much. So I have to unwind only this 250,000. So into 10% is 25,000 in my finance cost. Now, what will be the depreciation? Total amount of payment, that is 340, divided by for over how many period. Now understand, again you will make a mistake here. So I will tell you that this question is a you can say a bottle of mistakes, bottles, or you can say what we call Hindi may we say it as gadha, right? It's a okay, I'm not getting the word. Ignore. Okay. So basically this question is an area where you can make multiple mistakes. हर डग पे mistake हो सकती है. Okay, that's what we say in Hindi. Now, so understand, 90,000 is a payment that is first of the 5 annual payments for a lease and of an item of plant. The interest lease is this much. Now, what is the amount? Tell me, what is the lease term? What is the lease term? 5. So I have to depreciate it over 5 years. So 340,000 by 5 is 68,000. Okay. Now, so this is what is the amount that you will charge to P and L for lease, first lease. Now again you will make a mistake. So it says what is the total amount charged to statement of P and L for this lease. So let me make one more thing clear to all of you. So if the question says, listen to me very carefully. If the question says total amount charged to P and L for this lease, then you have to record finance cost plus depreciation both. If the says total amount charged to P and L for ROU, then again you have to write finance cost plus depreciation. But if the question says total amount charged to P and L for lease liability, then you have to record only finance cost. If the question asks for finance cost, then definitely finance cost. If the question asks for depreciation specifically, then depreciation specifically. Now, are you understanding this point? Now, in this question, it says what? What is the total amount charged to P&L for the year in respect of the above transactions? Okay, so total amount charged to P&L means finance cost plus depreciation. So what is the finance cost plus depreciation? 25,000 plus 68,000. This is the amount that will go to P&L. But now this is for the first transaction. But we have entered 2 lease transactions, right? So let's talk about the second lease transaction. On 1st January 2009, Hyper has made a payment of 18,000 for 1 year lease. Now, if it is a 1 year lease, tell me, will we record lease liability and ROU? Will we record lease liability and ROU? No. Why? Because we will take a recognition exemption, and whatever amount we are paying, we will record in the P&L as a rent expense proportionately on SLM basis. Now, what is the amount that we have made? 18,000 for 1 year on 1st January. What is my reporting date? 30th September. So 18,000 by 12 for 1 year. Now from 1st January to 30th September is 9 months. Jan, Feb, March, April, May, June, July, August, September. 9 months. So multiplied by 9 months is 13,500. So let us add all the 3 is the amount that will go to P&L. That is 25,000 plus 68,000 plus 13,500. That comes to 106500 is the amount that will go to P&L. Done. Tell me, clear everyone? Come on guys, tell me. Clear. Kausif, yes, you will get this PDF. No need to worry. Now, since I'm teaching, so focus on what I am teaching. You will get the PDF. Okay. Now, again, the one more wonderful question. Again, a wonderful question. On 1st January 2004, Badger entered into a lease agreement to lease an item of machinery for 4 years with rental of 210,000 payable annually in arrears. So the question has clearly stated that the lease payment are to be made in arrears of 210,000 for how many years? 4 years. Now, the asset has a useful life of 5 years, and at the end of lease term, legal ownership will pass on to the Badger. Okay. The present value of the lease payment is 635,000. That is your lease liability. This is your lease liability, 635,000. Since the payment is made in arrears, will I look into whether it is a total lease payment or future lease payment? Since the payment are made in arrears, I am not concerned whether the payment is payment here is future lease payment or total lease payment, because it doesn't make sense. It doesn't make sense. Okay, so it is a lease liability, 635,000. Interest rate is 12.2% for the year ended 31st December 2004. Badger accounted for this lease by recording a payment of 210,000 was operating expense. Oh my god, what has happened here? What has happened here? What has happened here? So basically Miss Dipakshi Goyal, understand, I will tell you that taking your point here in this session, I think will be unreasonable, will not be reasonable. I will sincerely request you, Dipakshi, that you go and watch my revision session. Okay, you go and watch my revision session. If you are comfortable in Hindi language, watch my FR in 8 hours. If you are not comfortable in Hindi language, you want English revisions, so FR students can also refer my SBR revision, wherein I have helped in the revision of the entire SBR in 15 hours. So FR students who are comfortable in English language can also watch that video. Okay, so Dipakshi, I will sincerely request you that your concept is weak here. Okay, this concept will take me time to explain, so I don't want to waste this time in this session. Okay, but I respect your query, so I will recommend you to go and watch my session. Okay, the link of the revision session is there in the description box of this video. Now, so 635,000 is my lease liability. The interest rate is 12.2%. And now what the question has done? See, read the question. Read the question. For the year ended 31st December 2004, Badger accounted for this lease by recording a payment of 210,000 as operating expense. Is that correct? Is that correct? No. We have to recognize lease liability and ROU, and in the P&L we record finance cost of lease liability and depreciation of ROU. But what they have recorded, the entire amount that they have paid recorded as a rent expense, which is wrong, which is wrong, which is wrong. So what I have to do? I have to rectify. I have to rectify. But tell me, comes the question, when have I discovered this question? When did I discover this error? This treatment was discovered during 20x5 and this error was of 20x4, previous year. So previous year financial statements would have been closed. Can I reopen my previous year FS? No, I can't reopen. I can't reopen. I can't reopen. So what will I do? I will give the impact. I will rectify the error in the current year and I will give the impact to retained earnings. I will give the impact to retained earnings. And where is retained earnings recognized? Statement of changes in equity. So now the question is, in the statement of change in equity, meaning thereby the question is saying retained earnings. In retained earnings for the year ended 31st December 2005, what adjustment will be necessary to retained earnings brought forward? Means opening RE. What is the adjustment? What is the adjustment to opening RE? What is the adjustment that we are required to do? Adjustment to opening RE. So now what you have to do? So we will see what is the wrong treatment given and what should be the correct treatment given. So wrong treatment is we have recognized a rent expense of 210,000 in P&L, and what is the correct treatment that we should record? A finance cost and a depreciation. So finance cost will be 635,000 ka unwinding rate of 12.2%. That is 635,000 ka 12.2% is 77470. 77470. Okay. Now depreciation is, now again you will make a mistake. Again you will make a mistake. Now tell me, generally we depreciate ROU asset over the lease term, but now since in this question it says that the asset will be transferred to the lessee at the end of lease term, means I will depreciate over the remaining useful life, which is 5 years. So I will depreciate over 5 years, that is 127,000. So I will record an expense of 204470. So ideally, I should have recorded an expense of this much, but I have recorded an expense of this much. So I have to reduce my expense of the previous year. I have to reduce the expense of the previous year, means I have to increase the profit of the previous year. If the expense reduces, profit increases. So I have to increase the profit of the previous year by how much? 210,000 minus 204470, that is 5530. So previous year profit should increase by 5530, means opening RE will increase by 5530. RE increases means credit. So credit RE by 5530. So A is the answer. I believe you are understanding this point. I believe you are understanding this point. Come on, guys, tell me. Now, coming to the next question. Going to the next question. This question is from sale and leaseback. This question is from sale and leaseback. Someone was asking me, Amsal was asking me sale and leaseback. So sale and leaseback concept point, Amsal, you can refer my revision video, sale and leaseback. But yes, I have taken a question. So definitely I'll discuss that here. Okay. Now, on 1st January 2006, see, in this session, my intent is to discuss important questions where you can make a mistake in the exams, okay? Or there are some adjustments which I can't find in the question, but I believe that you can make these mistakes in the exam. So I am discussing these sessions, discussing these questions with you, okay? This is my intent, okay? Now, Amsal is saying, sir, what amount would be considered as low value? So understand, lease is covered by the standard IFRS 16. So IFRS 16 is silent on low value. IFRS 16 is silent on low value. But every standard has a basis of conclusion. Okay, basis of conclusion. So as per the basis of conclusion of IFRS 16, it says that any asset up to $5,000 is called as low value asset. Okay, okay, Amsal. Now coming to the sale and leaseback concept. So it says on 1st January 2006, Slideshow sold a property for its fair value of 2 million. So sold for 2 million means 2 million is the sale proceeds. Transferring title to the property, Slideshow then leased it back on a 5-year lease, paying 150,000 per annum on 31st December each year. At 31st December each year, the present value of the rental payable was 599,000. So I will record a lease liability of 599,000. Interest rate is 8%. The carrying amount of the property on 1st January 2006 was 1.6 million. So I will de-recognize the property at its carrying amount. So the asset will be 1.6 million and it had a remaining useful life of 20 years. Need not worry. So see, what we are sorted here is bank we are sorted, asset we are sorted, lease liability we are sorted. Now we need to see what is the value of ROU asset. So we now know the ROU asset is recognized at the proportionate of the carrying amount, which represents the control that we have, regained as a result of lease back. Okay, so now this was my carrying amount, this is my lease liability, this is my fair value. So how to calculate ROU asset? The formula for that is carrying amount multiplied by lease liability by fair value is the formula. Okay, is the formula. So I have discussed the logic behind this formula in my revision session. Okay, so this is how you will record the ROU asset, and the difference is called as gain or loss on sale and lease back. Now the question is asking you three things: profit on disposal, depreciation and finance cost. So profit on disposal, we very well know it is 0.2802 million, that is 2802. So understand, so we can say that this option is wrong, this option is wrong, because profit on disposal is 400,000, which is wrong. So these two options are wrong. But A and D. So out of A and D, there is one right answer, one wrong answer. But which one is right, which one is wrong? So we now need to calculate depreciation and finance cost. So first of all, depreciation of ROU. Depreciation of ROU. So what we will do? Depreciation, we will depreciate over the lease term. Lease term is 5 years. So ROU is 0.4792. 0.4792 by 5 years is 0.09584 million. So depreciation is 95840. Depreciation is 11980. So A is the right answer. D is the wrong answer. So this is how you have to write the answer for this part. I believe it is very much clear to all of you. I believe it is very much clear to all of you. Come on, guys. Wonderful. Now moving on to the next question. On 1st October 2003, Fresco acquired an item of plant under a 5-year lease agreement, though I'll tell you in this question there is no complexity. In this question there is no complexity. This question is a very easy question, but I wanted to discuss a point of classification of current and non-current, hence I have taken up this question. Okay, this question is an easy question, but I have seen students struggling with the classification of current and non-current. So to clear up that point, I have taken up this question. Okay, on 1st October 20x3, Fresco acquired an item of plant under a 5-year lease agreement. The agreement had an implicit rate of 10% and required annual rentals of 6 million to be paid on 30th September each year for 5 years. So understand, we have taken on lease on 1st October, but we are paying at the end of the year, 30th September. At the end of year 30th September. Okay, now, so here what will happen? It is called as the lease payment are made in arrears. Okay, now, so what is the rule for classification? What is the rule for classification? Though I have explained the logic as well, but now here I will just give you the formula to calculate. If the lease payment are in arrears and if the lease payment are in advance, in both the cases, how will you calculate the current and how will you evaluate the current and non-current portion of the lease liability? So if the lease payment are in arrears, the non-current portion will be carrying amount of lease liability at end of next year. Now what is the current amount? Carrying amount of lease liability minus non-current portion. Okay, now if the lease payment are in advance, then your current is equals to amount paid at beginning of next year. Now non-current will be carrying amount of lease liability minus current portion. Okay, now in this case it is arrears. In this case it is the lease payment are made in arrears. Okay, so what is the question asking for? What is the current lease liability on 30th September 20x4? So now on 1st October 20x3, the present value is 23 million. Discount rate was 10%. So and the annual lease payments are 6 million. So 23 plus finance cost or at the rate of 10%, that is 2.3, and payment of 6, so equals to the closing lease liability on 30th September 20x4 is 19.3. so we now need the current and the non-current portion. To how? So since the lease payment are in arrears, so what we'll do, we will follow this rule. So what is the non-current? Carrying amount of lease liability at the end of next year. So what is the next year? The next year is 30th September 20x5. So what is the carrying amount of lease liability here? So plus finance cost of 1.93 minus payment of 6 is equals to 19.3 plus 1.93 minus 6 is 15.23 is the carrying amount on this date. Okay, so now this becomes your non-current portion. What is your current? So what is the carrying amount? 19.3 minus 15.23, 4.07 is your current. 4.07 million is this one answer. I believe you are understanding it. I believe you are understanding this point. Come on guys, tell me. Is that clear to everyone till here? Can I proceed further? Can you give me a confirmation if it is clear to everyone? Can you give me a confirmation if it is clear to everyone? Sir, what about current and non-current for loan notes? Is the same treatment you mentioned for lease? Yes, Afsar. Yes, Afsar Ali. So the same treatment, okay, because lease liability is also a financial liability, okay. So if there is a financial asset or a financial liability at amortized cost method, you have to follow the same method. Okay, now this completes my leases and I'm now coming to inventory. Do you need a break of 5 minutes? Do you need a break of 5 minutes? Come on, guys. Do you need a break of 5 minutes? But you have to promise that you won't go anywhere and you will be there here itself. Okay. So let us take a small break of 5 minutes, because we have solved how many questions so far? We solved around 14 questions now. We solved around 14 questions now. Okay. So let us take a small break of 5 minutes. Be here, and then we'll proceed further. Okay. Then we'll proceed further. Let us resume back. Okay. Can we resume back, guys? Can we resume back, all of you? After a short break of 2 minutes, can we resume back now? Come on, guys, show some energy in the class. Guys, how's the Joes, guys? Come on, come on. How's the Joes? The Joes should always be high. Okay, now let us resume back. Let us resume back. What is MTQ? Invictus is saying, sir, will we discuss MTQ? What is MTQ, my dear friend? Okay, let us resume back with inventory and a wonderful question again for the inventory now. But before I start this question, come on, all of you, tell me now, how do we value inventory? What is the principle behind valuation of inventory? Tell me. What is the principle behind valuation of inventory? The inventory is always measured at lower of cost or net realizable value. Lower of cost or net realizable value. Now, now the question is saying that Bounty company manufactures cycling equipment. It has a number of specialized frames in inventory. Frame is cycle frame, cycle frame. Okay, in inventory, which cost 20,000 to manufacture. These frames were manufactured following an order from a customer at an agreed selling price of 30,000. Due to recent technological advances, the current cost of manufacturing such frames is estimated to be 15,000. Okay, now understand. So, frames, the cost is 20,000. The cost is 20,000 and I have a contract from a customer. I have a contract from a customer to sell these frames at 30,000. Though I have not sold it yet, but I have a contract signed with a customer that I will sell it at 30,000. Now it says that there are some technological advancements, and now if I manufacture these frames, it will cost me only 15,000 to manufacture, but earlier it costed me 20,000. Now tell me, does this 15,000 has any relevance? Because to measure the inventory, we need cost and we need net realizable value. So cost, we now know 20,000. Cost is 20,000, NRV is 30,000, so we'll measure at lower of these two, that is 20,000. So 15,000 is irrelevant. 15,000 is irrelevant. Let us ignore that. So inventory, the frames will be measured at 20,000. So what is the answer? Frames will be valued at 20,000. This is the answer. Frames will be valued at 20,000. Now, again, it says Bounty company also has an inventory of 3,000 pedals with a cost of 20 each. So what is the cost of pedal? 3,000 into 20 is 60,000 is the cost. 3,000 into 20 is 60,000. Okay. Now these have become damaged. Now, if Bounty spends 5,000 to repair all of them, they could be sold for 21. So what is the NRV? So 3,000 units could be sold for 21. But if I incur 5,000, so the NRV is 58,000. So what is the lower? 58,000. So pedals will be measured at 58,000. So what is the answer? 58,000 pedals. So E is the answer for pedals. Is that clear, everyone? Easy question, but you could have got confused in the exam due to inclusion of this statement. You might be confused. Okay, you might get confused. Now I have a surprise to be announced. I have a surprise to announce for you guys. Tell me how many of you want to know the surprise. And trust me, the surprise, it will really surprise you. The surprise will really surprise you. Tell me how many of you wants to know the surprise. Come on. I want to see the chat box filled with it. The surprise will really surprise you. Come on, guys. Why are you not active? Recording won't be made available, guys. Surprise, please. Okay, ठीक है. So I think I should make some suspense for the surprise. So if you study with me till the end of the class, I will tell you the surprise. Okay? And trust me, the surprise is not like a normal surprise. Surprise is really a wonderful, valuable surprise which will help you a lot in the exam. I guarantee that. But for that, please be with me till the end of the class. On 30th September 2004, Razor's closing inventory was counted. Okay, if I want to ensure that I don't forget to give you the surprise, I will write here. See, I will write here. I will not forget. I will announce the surprise for you guys. Surprise. And this surprise will be given at the end of the session. Okay, I will give you the surprise. Promise. Now, On 30th September 2004, Razor's closing inventory was counted and valued at its cost of 1 million. Okay, it says on 30th September, the value of the inventory is 1 million. 1 million. This included some items of inventory which had a cost of 210,000. Okay, out of this 1 million, there was an inventory which had a cost of 210,000. Okay, which had a cost of 210,000 and had been damaged in a flood. This inventory which costed 210,000 was damaged in the flood. So basically, to help you in understanding this question, so understand this inventory which was of 1 million can be divided into two parts. One having a cost of 210 million, another have a cost of 1000 minus 210 is 790,000. Okay, 790,000. Okay, now so it says inventory for 790,000 was perfect. There was no challenge. But the inventory for 210,000, inventory costing 210,000 was damaged. This inventory was damaged. Okay, now it says these are not expected to achieve their normal selling price, which is calculated to have achieve a gross profit margin of 30%. It says that normally if I sell any product, I achieve a gross profit margin of 30%. But since it is damaged, it won't achieve that 30% margin. Since it is damaged, it won't achieve a 30% margin. Okay. The sale of these goods will be handled by an agent who sells them at 80% of the normal selling price. So now what happens here? Understand the question first of all. So now understand, let's suppose if selling price is 100, normal selling price is 100 and the gross profit margin that we charge is 30. So then what is the cost? 70. Tell me 70. Come on guys, tell me 70. But now tell me, we are selling these goods of cost 70. We will be selling at what value? Tell me. We will be selling at 80% of the normal selling price. What is the normal selling price? 100. So we are selling at 80. 80% of normal selling price is 80, right? So now understand this 210,000. Don't you think it represents the cost? So what is the selling price? What is the sale price? So 210,000 divided by 70 because it represents cost. Now the normal selling price is 80. So what is the sale price? So 210,000 divided by 70 into 80 is 240 is the normal sale price. 240 is the normal sale price. Okay. Now what we have to calculate NRV. So the question says that the agent will also charge a commission of 25%. So now what is the commission? What is the cost to sell? 25%, that is minus 60. So it is equals to 180 is the NRV. 180 is the NRV. So 180 is the NRV here. 180 is the NRV. So what we have to do? We have to value it lower of cost or NRV. That is, we have to reduce the value by 30,000. We have to reduce the value by 30,000. So what is the revised value of inventory? So 1 million minus 30,000 is equals to 1 million minus 30,000 is equals to 970,000. Is that clear, everyone? Okay. Now this sale price of 180 can be calculated in a different manner also. How? So it's saying that if the cost is 210, the cost price 70. So what is the normal selling price? So normal selling price is 300. But now what is the selling price in this case? 300 ka 80%, that is 240. Now minus what is the cost to sell? That is 25% is the transaction costs, that is 60. So it becomes 180. So you can calculate either ways. I believe it is very much clear to all of you. So now what we have to do? We have to reduce the value of inventory by 30,000. So 1 million minus 30,000 is equals to 970,000. Okay. Now coming on to the next question. At 31st December 2004, Which company had in inventory 100 items of work in progress? Now again, this question is, there is no complexity in this question. There is no complexity in this question, but still I want to discuss this question with you guys. Still I want to discuss this question with you guys. Why? Because I believe that the students don't understand this concept. Okay, so understand, students have a very well knowledge that inventory has to be valued at lower of cost or net realizable value. Okay, now the cost they calculate very well. Now NRV they calculate as estimated selling price minus cost to sell, minus cost of sale. But now if it is a case of work in progress, if it is a case of work in progress, while calculating net realizable value, we are also required to minus cost to complete. We are also required to minus cost to complete. Okay, now understand. So at 31st December 2004, Leach company had in inventory 100 units of work in progress, which had 14,900 to produce, which cost, so cost is 14,900. It estimated that the work in progress would cost 13 per unit to complete. This is the cost to complete. So now, and each unit would sell for 166. So what is the estimated selling price? 166 into 100 minus what is the cost to complete? 13 into 100 minus what is the cost to sell? Transaction cost is 2% of revenue, that is 166 into 100 ka 2% is the cost to sell, is the cost to sell, is the cost to sell. So what is the value here? 14968 is the value of NRV. 14968 is the value of NRV. Now we have to value at lower of cost or NRV. So what is the cost? 4900. What is the NRV? 4968. What is the lower? 4900. So answer is 14900. Is that clear, everyone? Is that clear, everyone? So always keep in mind, so understand, when you calculate net realizable value for a finished goods for stock in trade, it is equals to estimated selling price minus cost to sell. But if you are calculating the net realizable value of work in progress, it is equals to estimated selling price minus costs to sell minus cost to complete. Please keep this in mind, my dear students. Is that clear to all of you? Is that clear to all of you? Then value at lower of cost or NRV. Then value at lower of cost or NRV. Okay, now next part is coming to revenue chapter. And this question again, a wonderful question. If a question like this would have come in the exam, definitely you would have made a mistake. This is not a normal question. This might appear that it is a normal question, but it is not. It is not. Trust me, it is not. Whenever I have taken up mock test, see, in my regular sessions, I do conduct mock test. So when I take a mock test, students have always made a mistake in this question. Always they have made a mistake in this question. Okay, even after telling multiple times in my regular sessions, still they make mistake here. Okay, so now, but I don't want you guys to make this mistake in the exam. I don't want you guys to make a mistake in the exam. No. Can we start? Revenue from contract with customers. CN started a 3-year contract to build a new university campus on 1st April 2004. The contract had a fixed price of 90 million. CN will satisfy the performance obligation over time. Now tell me what I have always told. Whenever the contract is over time, what is the first thing that you will go and check? Tell me. What is the first thing that you will go and check? Tell me, guys, come on. If the contract is over time, what is the first thing that you will go and check? Tell me, guys, come on, I need answer from each one of you. What is the first thing that we go and check? Whether the overall contract is a profit making contract or a loss making contract, or it is uncertain because the contract is in initial stages. It is a profit making, loss making, or it is uncertain. Okay, now see here in this case, what is happening here? What is happening here? The contract has a fixed price of 90 million, meaning thereby revenue is 90. Okay, now see an incurred cost of 77. This much cost is already incurred, and a further cost of 33 million. So what is happening? Tell me, revenue of 90 minus cost of 77 plus 33, which is equals to how much? 90 minus 110 is negative 20. Loss making contract, loss making contract, loss making contract. Oh my god, loss making contract. So what to do now? What to do now? So if it is a loss making contract, what you have to do is, first of all, calculate revenue and cost. Calculate revenue and cost normally using input method or output method as the question says. Then what we do in the second step, calculate overall loss. Calculate overall loss. Third stage, see what is the loss already recognized. What is the loss already recognized? Fourth step, what is the loss yet to be recognized? Yet to be recognized. For the loss yet to be recognized, what we do? We pass entry cost of sales account debit to provision for onerous contract. Provision for onerous contract we will record in the P&L. We will record in SOFP as a liability, and this loss, which is a future loss, you will add to the cost of sales. Meaning thereby, if there is a future loss with the loss which is yet to be recognized, we will recognize it today itself. We will recognize it today itself. We will recognize it today itself. Why? Because we can't cancel this contract and this loss will happen to me. So I have to recognize all the future losses today itself as provision for onerous contract. Okay. Now, how will we solve this question? So first of all, read the question. So contract price is this much, cost is this much. CN measures the progress of contract using work completed compared to contract price, means output method, Okay, now as at 31st March 2005, surveyor valued the work completed to date as 63 million. So now what is my revenue? 63 million. That is sorted. That is no challenge. That is not a challenge. That is not a challenge. That is not a challenge. Okay. So it is revenue 63 million. Now tell me, what is the percentage of completion or the measure of progress? It is equals to 63 by 90 is equals to 70%. Now what is the cost that you will recognize? Understand. So the revenue that you have recognized is 63. Cost that you recognize, what is the cost incurred till date? 77. So the cost which you recognize is 77. So what happens here? What is the loss? 63 minus 77 is 14 is the loss that you recognize. What is the overall loss? 20. What is the loss yet to be recognized? 6. So what will you do? You will add the 6 to here. So what will happen? Your revenue will be 63 and your cost of sales will be 77 plus 6 is equals to 83, and hence you are recognizing the entire loss 20 here itself. Are you getting my point? Are you getting my point? Are you getting my point? Tell me, guys. So cost of sale will be 83 and most of you will write 77 in the answer. And you will say, sir, my answer is right. But no, my dear friend. So these are very small points where you could have made mistakes in the exam. Okay. Now understand. Tell me, is that clear, all of you? Is this question clear to all of you? This is a very important question. Now, on 1st October 20x2, the next question. On 1st October 20x2, Pricewell Company entered into a contract to construct a bridge. The total contract price was 50 million. And the construction is expected to be completed on 30th September 2004. The contract is expected to generate a profit for Pricewell Company. Oh, see, the question has clearly told that it is a profitable contract. It is a profitable contract. Now, are we required to evaluate the same? Are we required to evaluate the same? No, the question has given us clearly. Okay, wonderful. Now, the customer obtains control of the bridge as the construction takes place. Okay, fine. Now, allocation of the management time to obtain contract, material cost, depreciation cost is this much, the value of the work completed at 31st March 2003 has been agreed at 22 million and the estimated cost to complete is 10 million. Pricewell recognizes satisfaction of performance obligation by value of work completed to date, means output method. So what is the work completed? 22 million. So this revenue is 22 million. Now what is the cost? What is the cost? What is the cost? Now these three are the costs that we incur. Now tell me, what is the cost of sales? So understand, my dear friend, this cost, is it a cost to construct? Is it a cost to construct the bridge? No, no, no. This is a cost to obtain the contract. This is a cost to obtain the contract. So are we going to recognize this? No. So we will say the cost to sell is 15. So 15 million. So 22 minus 15 is your profit of 7. So what is the profit recognized? 7 million. So this is the answer, 7 million. Okay. Because this is a cost to obtain the contract. What are we saying? This much is the percentage of work done. And this is the value that I am supposed to receive from the customer. Okay. Now, and this 15 million is the cost that I have incurred to generate a revenue of 22 million. Okay. This 15 million is the cost that I have incurred to generate a revenue of 22 million. Okay. So revenue and cost of sales, applying the matching concept, Is that clear, everyone? Josefa is getting confidence. Wonderful, guys. Wonderful. So now if you are saying confidence, then even I am getting confidence. So your words boost my confidence a lot. Thank you, guys. Now, on 31st December 20x1, AB entered into a transaction to sell a legal title to inventories. Again, this question, I'll tell you. This question is not something very difficult. But in this question, if it comes in the exam, I'll tell you, you will make a mistake between these 2 points. You had the concept, even if you had the conceptual clarity, still you will make a mistake in the exam in this question. Why? Because you didn't read the question properly. And that's why you will make a mistake in the exam. So now using this question, we are getting to know how to understand, how to read the question in the exam. Okay. On 31st December 20x1, AB entered into a transaction to sell legal title to inventories, which would take time to mature. The cost of inventory is 450,000. Okay. The inventories were sold to a financial institution. So I'll draw a diagram here. See. So this is an entity. What happened? Okay. The pencil has went down, but no worries. I will try to write with my hand now. So understand. So this is okay. Why I'm not able to write? Can't I write with my hand? Okay, no worries. Take care. So this is the entity. Okay, entity has an inventory. The cost of inventory is how much? 450,000. Cost of inventory is 450,000. Inventories were sold at 420,000. Okay. Now, with an option which allows the entity to repurchase at 463,050. So now understand, when I sold the inventory, I received how much? 420,000. I received how much? 420,000. Now the question says that I have a right to purchase. I have a right to repurchase. Now, when will I repurchase? Tell me. Which allows on 31st December 20x3, means after 2 years, at year end 2. And if I repurchase, I have to pay an amount of 463,050. Okay. Now, At that date, the selling price of the inventories would be approximately 540,000, and it was expected that AB would exercise the option. Now tell me, what have I told here in the class? If the repurchase price is greater than the original selling price, it is and it is certain that the entity will exercise the repurchase option, then what will happen? Tell me, then what will happen? Then what will happen in that case? So we say it is a case of nothing but a financing arrangement. It is a case of financing arrangement. Now tell me, since it is a case of financing arrangement, will I de-recognize my inventory? No, I will not de-recognize my inventory. So my inventory will remain at its cost of 450,000, but rather whatever amount of 420 which I receive is called as financial liability. So I will just record one additional entry called as bank account debit to financial liability. Now understand, let us read the options. Inventory costing of 450, okay, should be recognized in the cost of sales, and revenue of 420, nah, because a repurchase arrangement and the repurchase option is likely to be exercised. So we can't recognize revenue and cost of sales. Inventory should be recognized in the statement of financial position at 420. Why? The cost of my inventory was 450, no? So I will recognize at 450 only. So this also option is also no. Inventory should be recognized in financial position at 450. Okay, correct. And 420 received should be recognized as liability. Correct. There is no profit or loss. Why? Okay, dicey. Okay. Hold it now. Inventories should be recognized in statement of financial position at 4.5. Correct. 420 received should be recognized as liability. Correct. See, both the options appears correct. Now here it says interest expense of 43050 using the effective interest rate should be reported in P and L. Now this option seems more relevant, but now let us read the requirement once. How should the above transaction be accounted in the statement of financial position for the year ended 31st December 20x1? And on what date did we enter into transaction? 31st December 20x1. Now tell me, on the date of transaction, will I record finance cost, or I will record finance cost over 2-year period? So I will record the finance cost over 2-year period. On the date of transaction, I will simply record this entry. I am not going to record any finance cost. On the date of transaction, I am simply going to record this entry. I am not recording any finance costs. I will be recording finance cost, but over 2-year period, not now. Okay, so this answer is correct, and this answer is wrong. Though logically third and fourth both were correct, but according to the requirement of the question, fourth is wrong. Is that clear, everyone? Pierce company sells 24,000 of goods to level company on 19 December 2007. Okay. Pierce company invoices the level company on that date, but it agreed. So what happens here? Understand the question first of all. So it says on 19th December, entity sold goods valued at 24,000. Okay, sold goods valued at 24,000. Okay, now on 19th December, and the entity invoiced the goods and it agreed to deliver. The goods, but the customer is saying, I don't want delivery now. The customer is saying, I don't want delivery now. Give me the delivery after on 20th January. After 1 month, give me the delivery after 1 month. Give me delivery after 1 month. Now tell me, will I recognize revenue on 19th December or 20th January? This is my question. Tell me, will I recognize revenue on 19th December or 20th January? So understand, this is a case of bill and hold arrangement. My dear friends, this is not a time to give advice. Whoever needs advice, ping me after the class. Okay, I will give you the advice. Now all of you, please focus on this question. Okay, even single minute here and there, if you are not focusing on the class, you are losing out on that. Okay, you are losing out on your time. You have very less time left for the exam, so value each and every minute of yours. Okay, so we will recognize the revenue on 19th December, not 20th January, because entity is ready to transfer the goods, but the customer is selling, Arey bhai, I don't need goods now. I don't need goods now. I don't need goods now. You give me after some time. Okay, so entity has transferred the control. Entity has transferred the control. See, how will you evaluate that entity has transferred the control? I will highlight those words. Okay. Customer does not need the goods until then, but has placed the order as the goods are in short supply. Means customer has requested the arrangement. Entity places the goods in a separate area of the warehouse, and they are specifically identified as belonging to the customer. Okay. Now, as the customer has been invoiced, Pierce company records it as sale and trade receivable. Pierce company records as a sale and trade receivable. So revenue is recognized correctly. Revenue is recognized correctly. Okay. Now the goods are included at cost in the stock take. Oh my God. So they included the goods in the closing stock. They included the goods in the closing stock. So if it is in the closing stock, it is not there in the cost of sales. So what we have to do? We have to record cost of sales and we have to decrease closing inventory. We have to decrease closing inventory. So this is the entry which we have to pass. Right? Now at what amount? See, 24,000 is the sales, is the sale value, but we will record cost of sales at the cost value, right? So what is the cost value? The margin is 15%. So what is the cost? 85% of it, right? So 24,000 ka 85% is 20,400. So we'll record 20,400 cost of sales and decrease inventory by 20,400. So what is the entry? Revenue? Nah. Trade receivable? Nah. Cost of sales to inventory? Yes, 20,400, not 24,000, not 24,000. Why? Because 24,000 is the sales value. We will decrease the inventory by the cost of it. Okay. Is that question clear, everyone? Is this question clear, everyone? Now, so this completes my revenue chapter also. Now coming to this question of government grant, a wonderful question. It was there as part of mock exam 1, question number 3. In almost every batch, I get this question as a query. Okay, in almost every batch, I get this question as a query. So why not? Let us discuss this question with you guys. Let us discuss this question with you guys now itself and sort it out for once for all. Once for all. Now understand. It says on 1st January 2006, Garden Bucks received a 30,000 government grant relating to the equipment which cost 90,000. Okay, now understand the question first of all. Subham Pipalia, my dear friend Subham, someone else has also, I believe someone else, I'm not able to recall the name of that student, but someone has asked me the same query of adjusting and non-adjusting event. Don't worry, I am here to help you out with the same. I will explain you, I promise. Okay, so when I reach the chapter of provisions, just ask me this query. I am promised to explain you this point. Okay, but not now. Okay, for now, focus on this chapter. Now understand. So it says on 1st January 2006, Garden Bucks received 30,000 ka government grant for an asset which costed 90,000. Okay, which had a life of 6 years. So highlight few points. 30,000 government grant for an asset costing 90,000, the life of which is 6 years. The grant was netted off against the cost of the equipment, meaning thereby what I'm doing here, understand please. So we are following the net method of grant related to asset. I am following the net method. On 1st January 2007, when the equipment had a carrying amount of 50,000. So first of all, let us calculate what is happening here. Understand? So the question is, the important part of this question is on 1st January 2007, when the equipment had a carrying amount of 50,000, its use was changed so that it is no longer being used in according to the grant. It is no longer used in accordance with the grant. It means grant is repayable now. This meant the grant needs to be repaid in full. On 1st January 2007. Okay, but we will repay by 31st. So government has given you a bandwidth. Government has given you a bandwidth that you need to repay by 31st December, but it is repayable with effect from 1st January. So the obligation to pay arises on 1st January, but we can pay by 31st December. So now understand what is the treatment that we would have applied. Cost of 90,000, grant of 30,000, netted of 60,000. Okay, this is the cost on 1st January 20x6. Now what is the depreciation for 20x6? 60,000 divided by 6 years ka useful life, that is 10,000, and on 31st December 20x6, or you can say 1st January 20x7, the carrying amount happens to be 50,000. Tell me yes or no. The carrying amount happens to be 50,000. Tell me yes or no. Come on, guys, tell me. So this is what? So this is what the question also said. This is what the question also said. 50,000. Right? Now, accounting if there is no grant. Now the grant is repayable, right? So what to be done? What needs to be done? What is the accounting that we need to do? So we need to see what would have been the accounting if we would not have received the grant itself. What would have been the accounting? So 90,000 ka cost minus no grant. So net is this much. 15,000 is the asset and 75,000 will be the value of my asset on 1st January 20x7. So what is happening? I will increase the depreciation of by 5,000. I will increase the value of the asset by 25,000. I will increase the value of the asset by 25,000, and I will record a grant payable of 30,000. So depreciation account debit 5,000, asset account debit 25,000, and grant repayable 30,000. Okay, but now if you write this in the exam, your answer will be wrong. Why? Because see the question. Using the drag and drop options in the table below, create the journal entry required to reflect the correct accounting treatment of the grant and the equipment for the year ended 31st December 20x7. If the question would have asked, suggest the correct or rectification entry on 1st January 20x7, then in that case, this entry is correct. But the question is asking you correct entry for 31st December 20x7. So now, meaning 25 minus 15 is asset increasing by 10,000 and the grant repayable is 30,000. So this is the final entry. So be very careful in the exam or for the dates. If the date was 1st January 20x7, you were required to write this entry. If the question is asking for the year ended 31st December 20x7, means the question is asking for the entire year. So we have to write both entries. Are you understanding this point? Come on, guys, tell me. Are you understanding this point? Wonderful. So now this completes my chapter of government grant. Now I'm coming to financial instruments. Let us take a break of 2 minutes so that you can relax yourself, gain some energy, and then restart. Okay, 2 minutes, just 2 minutes. Relax yourself and then we'll restart again. But no one will go anywhere because you remember, no, I have to give you surprise. I have to give you one surprise. So don't go anywhere. We will be here itself just after 2 minutes. Let's meet after 2 minutes, a small break. Okay. Okay, everyone back from break. Come on, guys. Come on, guys. Let us resume. Let us resume. Okay, now tell me who wants to know the surprise? Who wants to know the surprise? Come on, guys, tell me. Come on, guys, tell me who wants to know the surprise. I want to see the movement in the chat box. Come on, come on. I am disclosing the surprise now. I am disclosing the surprise now. So the surprise is that tomorrow evening 6 p.m. we are going to have a session, and the session will be for the all the theory of ACCA FR. So now what I'll do is whatever are the relevant points of ACCA FR, I will explain that, and whatever are the relevant questions of ACCA FR, I will discuss that as well. Okay. So now tell me, will that be helpful for all of you? Will that be helpful for all of you? Come on, I need a response. Will that be helpful for all of you? So now Vishal Jain is on a mission to help the students pass the exam. Definitely, 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 definitely. Done. Wonderful. So now the Joes is high. The Joes is high now. Tell me, guys, the Joes is high now. So let us come back to the session and practice further. Practice further. Aajo. Coming to the financial estimate, see, out of 30, we have already done. I have already done 21 questions, 9 questions remaining. Let us maintain the momentum and complete these questions as well. Entity issues 3,000 convertible bonds at the start of year 1 at par. Just give me a minute, please. An entity issues 3,000 convertible bonds at the start of year 1 at par. They have a 3-year term and a face value of 1,000 per bond. Just a minute, guys. 3,000 convertible bonds at the start of year 1 at par. They have a 3-year term and a face value of 1,000 per bond. Interest is payable annually at arrears at the rate of 7% per annum. Each bond is convertible at any time up to a maturity up to 250 common shares. The bonds are issued at the prevailing market rate. For similar debt without conversion rate is 9%. The relevant discount rates are given below. You have to break the instrument to debt and equity elements. So now what I have told in my lectures, tell me guys, come on. So now it is a compound financial instrument. It is a compound financial instrument. So now for any compound financial instrument, you need to break the instrument into two parts, FL and equity. For that, analyze it independently. So principal, interest and conversion right. So understand, conversion right will always be equity. Interest or dividend, if it is mandatory to be paid, it is a financial liability. And if it is discretionary or optional to be paid, if it is discretionary at the discretion of entity, then it is equity. Principal, if it is compulsorily convertible to fixed number, if it is compulsorily convertible to fixed number, it is equity. Rest, otherwise it is financial liability. Now in this case, tell me, issues convertible bond, anywhere are they mentioning compulsorily convertible? Tell me, are they mentioning compulsorily convertible? No. So what happens? Principal is what? Financial liability. Now the question says what? They have the interest payable annually in arrears at the rate of 7%, means interest is mandatory to be paid. It means financial liability. Conversion right is always equity. So now in this question, principal and interest is a financial liability. So what we will do now, we have to find out the value of financial liability and equity. So for that, what we will do is we'll calculate the present value of the principal and the interest using market rate of similar instruments, without the conversion rights, that is at 9%. So we'll calculate the present value at the rate of 9%. So now tell me, first of all, tell me what is the principal. 3,000 bond at the rate of 1,000 per bond. That is how much? 3,000 into 1,000. That is 30 lakhs at the rate of 0.766. Why? Because the principal will be repaid at the end of third year. So principal will be how much? 30 lakhs multiplied by 0.766 is equals to how much? Someone please calculate that. Now interest is how much? 30 lakh multiplied by 0.07 is 210,000. Now this 210,000 has to be paid every year, right? Every year. So we will have to take annuity factor, that is sum of these three. So what is it? 0.914 plus 0.837 plus 0.766. That comes to 2.517. 2.517. Can anyone tell me what is the total of these? Can anyone tell me what is the total of this? So Bhavini has told me it is 2298000. Okay, no, not cannot be the case. So this can be 2298000. 2298000. Now this will be 210,000 multiplied by 2.517. That is equals to 528,570. So plus 2298000. That is comes to 2826,570. Value is 30 lakhs of the entire instrument. So what is the value? Minus 30 lakh. That comes to 173,430. 173,430. So this is the answer. Debt is this much, equity is this much. Done. Was that difficult, my dear friends? Tell me, was that difficult? No. Then why I took this question? Because this is the most asked question in the exam. Was this question difficult? No. Was there any chance of making a mistake in the exam? No. Then why did I took this question? Because this is an important question. Okay, this is a favorite question of the examiner. Okay, so hence I took up this question. Now ABC purchased 1,000 shares on 1st September 20x4, making the election to use the alternative treatment under IFRS 9. Can you tell me what is the alternative treatment? Can anyone tell me what is the alternative treatment for investment in equity instrument? That is FVTOCI. Now Kausif is telling me, sir, what is the meaning of 250 in this question? It just says that it is convertible to fixed number of equity shares. In this question, it means this 250 means it is convertible to fixed number of equity shares. But this fixed number of equity shares has no relevance, till the time it is not compulsorily convertible. If it would have been compulsorily convertible, if it was written here compulsorily convertible to fixed number of shares, then this principal portion would have become equity, and we would not have calculated the present value of the principal in that case. Okay. Now coming to the next question. So ABC purchased 10,000 shares, making the election to use alternative treatment. So alternative treatment means what? FVTOCI. Now why I have taken this question? Just to make one point very much clear to all of you. The point here is, whenever the financial asset is at FVTOCI, we capitalize the transaction cost to the cost of asset. Now, so I have purchased 10,000 shares at a price of 3.5 each and incurring a transaction cost of 500. So what is the initial value of my investment in equity instruments? 10,000 into 3.5 plus 500. That is 35,500. Okay. Now, what is the year-end value? 4.5. So 10,000 into 4.5 is 45,000. So what is the gain or loss? So 45,000 minus 35,500, that comes to 9,500 is the gain which will be recognized in other comprehensive income. Now, though the question is not asking you, but if this question we solve as per FVT, P and L, then how are we going to solve this question? So in that case, what will I say? I will record initially my investment at 35,000 and the 5,000 ka transaction cost will go to P and L. Now here I will record at 45,000 and this gain, fair value gain will be equals to 10,000, which will go to P and L. This will also go to P and L. Okay. Is that clear, everyone? Now, coming to the next question. On 1st January 20x1, Penfold company. Now, why I have taken up this question? This question is a very easy question. Why I have taken up this question? To help you realize the importance of reading the requirements properly. Okay, to help you realize the importance of requirement. Now, in this question, whenever I have taken up a mock test in the classes, in my regular classes, in this question, you know what? Students showed that they know the concept, but still they made the mistake. Why? Because they didn't read the requirement properly. So in this question is not testing your knowledge. No, because you already know this question. This question, rather, it is testing how well, how patiently are you reading the requirement, is what is being tested in this question. Now understand, on 1st January 20x1, Penfold company purchased a debt instrument for 500,000. So definitely I will record it at my purchase price, that is 500,000. Principal amount is this much. So this is the face value. Due to be mature in 5 years, the debt instrument carries a fixed interest rate of 6% to be paid annually. So this is the contractual cash flow and effective interest rate of 8%. Now tell me, finance income I will record at the rate of 6% or 8%? Finance income we will record at the rate of 6% or 8%? Tell me. Finance income or finance cost we record at effective interest rate, which is 8% in this case. Okay, so I will record finance income at the rate of 8%. Now contractual cash flows I will record at the rate of 6%. Understand? So now finance income I will record at the rate of 8% on this opening balance. I will record on the opening balance. Okay, so what is the finance income for the first year? Tell me. What is the finance income for the first year? Tell me. 500,000 into 0.08 is 40,000. Okay, 40,000. But now, what students will do, they will see, oh, I have to calculate the value of the debt instruments in the SOFP. They will say, my finance income is 40,000. I am paying 33,000. How 33,000? 6% of 550,000. Now, what you can do in the exam, you will calculate 6% of 500,000. Wrong. 6% of 550,000. So what is 550,000 into 0.06? is 33,000 because contractual cash flows you calculate. So understand, contractual cash flows you calculate at the coupon rate multiplied by face value. You apply it on face value. But finance cost or finance income you calculate at effective interest rate multiply by the carrying amount at beginning of year. Okay. So now, so finance income we calculate at the rate of effective interest rate at the beginning of the year, whatever is the carrying amount. So that's what we calculated. Now this 33,000, how come? 6% of 550,000, 6% of 550,000, 6% of 550,000. Okay, that is 33,000. So the carrying amount comes to 507,000, and the students are what they will do is they will try to say my answer is 507,000, but why that is not in the answer? Why that is not in the options? There is something wrong in the question itself, but that is not the case. Understand, the question is asking you the carrying amount at 31st December 20x2, that is on this date. So add finance income minus contractual cash flows, and this is the amount. Okay, is that clear everyone? I believe you are understanding. I believe you are understanding. So in this question we understood two things. What is the contractual cash flow? How will we calculate contractual cash flows? How will we calculate finance income or finance cost? And we have to read the requirements properly is what we understood from this question. Now moving on to the next chapter, that is income taxes. That is income taxes. Now this question is again a very easy question. Now how many questions left? 1, 2, 3, 4, 5, 6 questions. Just 6 questions left, guys. Just 6 questions left. So please maintain the momentum and let us complete these 6 questions and we will be done with it now. Okay, now income taxes. Income taxes. So understand what is the question. So it says the plant, understand here, the plant, for plant, it is at cost model. Cost less depreciation means at cost model. Plant is at cost model. Okay. The carrying amount is 110,000 and tax base is 90,000. So definitely it means your temporary difference is 20,000. Okay. Now since carrying amount is greater than tax base, carrying amount is greater than tax base, it means it is a taxable temporary difference. It means it's a taxable temporary difference, okay, which will give rise to a deferred tax liability at what rate? 20% means 4,000. 4,000. Okay. Now for land, what is the carrying amount? For land, what is the carrying amount? So plant is over here. Let me add a page. Add page. I will discuss land in the next page. Land carrying amount is how much? 200,000 and carrying amount is 280,000 and 280,000 and tax base is 200,000. So a temporary difference of 80,000. Now tell me, why temporary difference? Why temporary difference? Why temporary difference? Because land is under revaluation model, because there can't be any other reason of difference. There cannot be any other reason of difference because land we don't depreciate. Land we don't depreciate. So there cannot be any other reason of difference for land. So it means this difference is due to revaluation gain of 80,000. Okay. Now, so definitely it is a taxable temporary difference and we will create a deferred tax liability at the rate for 16,000. Now comes the question, at year end, what is your deferred tax liability? 16,000 plus 4,000, that is equals to 20,000. Is your deferred tax liability. What is your revaluation surplus? So revaluation gain is 80,000 minus deferred tax impact is 16,000, that is equals to 64,000. Now what is the question asking for? So question is saying deferred tax liability of 20,000 and revaluation surplus of 64,000. Now amount of deferred tax liability is correct or incorrect? It is correct. Amount of revaluation surplus is correct or incorrect? It is correct. Is that clear everyone? Tell me. Is that clear everyone? Is that clear everyone? Come on guys, tell me. Okay, wonderful. Moving on to the chapter of provisions. Moving on to the chapter of provisions. So now let me complete provisions. Then Vedika, you and someone else also. I forgot the name. See, I am not able to recall the names. So please, I'm sorry for that. But someone asked me for events. So one was Vedika because she told me. So I remember her name. One more should ask me about events. So I will discuss the events after this. Okay. Now provisions. So now tell me, when do we recognize provision? When do we recognize a provision? Okay, so provision we have to recognize when it is a, understand, when do we recognize provision? So we recognize provision when it is a present obligation, when it is a present obligation plus outflow is probable plus amount can be measured. Amount can be measured reliably. It is then in that case we recognize it as a provision. Okay. Now understand, AP has the following two legal claims outstanding. A legal action claiming compensation of 500,000 filed against AP. This is a case against AP. So it's my obligation. It's my obligation. Okay. A legal action against OP. Okay. It is more likely than not that the amount claimed will have to be paid. More likely than not means outflow is probable. More likely than not is outflow is probable means more than 50% it is chances that I have to pay 500,000. So now understand, for legal action against AP, I will make a provision. I will make a provision. I will make a provision. Now, a legal action taken by AP against a third party. So now here what is happening? AP has taken a legal action against someone. So now here for 2,000. So the other party has to pay 200,000 to AP. Other party has to pay 200,000 to AP. And the inflow is probable. The inflow is probable. So now can I record that as an asset? No. So see, understand my dear friends. So if it is a case of outflow or if it is a case of inflow, so outflow there are three levels: liability, provision and contingent liability. But inflow we have only two things: asset or contingent asset. There is nothing in between. And we can recognize anything as an asset only if it is virtually certain. That is, it is the probability of receiving is more than 95%. Means it is certain that I will receive. It is certain that I will receive. But here it is not certain. Here it is more likely than not. It is probable that I will receive, but it is not virtually certain. It is not virtually certain. It is not virtually certain. When will it become virtually certain? When I will win the case. When I will actually win the case. In that case, it will become virtually certain, and then I can recognize it as an asset. But until then, I cannot recognize it as an asset. So far, I will disclose it as a contingent asset. I will disclose it as a contingent asset. I will disclose it as a contingent asset. Is that clear, everyone? Is that clear, everyone? Just to help you out with one thing, just give me a minute, please. I will help you out with one thing. Provisions, if you want, you can take a snapshot of it. Okay, understand, if it is a present obligation, and the outflow is probable, amount is certain, or even if amount is uncertain, amount can be estimated, then in these two cases we make a provision. If amount cannot be estimated, contingent liability. If the outflow is not probable, contingent liability. If it is a possible obligation, contingent liability. Okay, if you want, you can take a snapshot of it, or in the group there is an SBR capsule. We can refer that SBR capsule. In that SBR capsule also you will find this diagram drawn there. Okay, now coming to the next question. This question is from the point of view of restructuring, and I don't see any reason to discuss this question, but I understand that this question is one of the favorite question of the examiner. So understand, whenever there is a restructuring, what are the items to be included in the restructuring provision? So we will include redundancy cost, we will include lease termination cost, but will we include retraining of the continuing employees? No. Will we include relocation of the continuing employees? No. So whatever, whoever the employees who have been affected as a part of this restructuring, for that only we have to make a provision, means we have to make provision of this much. So that is 100,000. Sorry, 1 million. 1 million. 8,800 plus 200 is 1,000. So we have to make a provision of this much. So these two, for these two, we will not make a provision. Now coming to this question of provision for decommissioning. Okay, after this question my provisions will end, and before starting foreign exchange I will discuss events. Okay, which you guys have asked, you have requested me, so definitely I will discuss that part as well, no worries. On 1st October 2003, Explorer commenced drilling an oil in the undersea oil field. Okay, the extraction of the oil causes damage to the seabed, which has a restoration cost. Okay, ignore discounting. So the question clearly says that whenever you are extracting the oil, for that you are not required to do the discounting. So I'm not doing discounting. If the question would not have said about this line, we would have discounted this. I would have discounted this. Okay, now 10,000 per million barrels. Per million I have to incur 10,000. Okay, now how much I have extracted? 250 million barrels I have extracted. 250 million barrels. So how much provision I have to make? 250 into 10,000, that is 2.5. Okay, now further, so for this, will I calculate the present value? For this, will I calculate present value? Ideally yes, but since the question has clearly said no discounting, I am not doing discounting of it. Okay, ideally yes, but since the question is clearly said, so I am not doing discounting of it. Now further, Explorer is required to dismantle the drilling equipment at the end of 5-year license. The cost is 30 million. Explorer's cost of capital is 8% and the present value is 68 cents. So for this, I will calculate the present value. So this is 30 multiplied by 0.68 is 20.4. So total provision of 22.9 on this date, I will make a provision of 22.9. But what is the question saying? What is the total provision on 30th September 20x4? So on this date, the question is asking you. So now tell me, if we have not calculated the present value, will we unwind this? No. So we will unwind only 20.4. We will unwind only 20.4 at the rate of 8%. So 20.4 ka 8% is 1.632. So what is the provision? 24.532 here. 24.532 here. Is that clear, everyone? So this completes my chapter of provisions. But since you guys have requested me and I can't deny your request, so I am coming up here with the point of events. Now Vedika and one more student and others, can I request you one thing? Since you have requested, can I request you one thing? See, I have already uploaded a video. Of SBR revision in 15 hours. In that, see, these are SBR notes. Okay, so in that I have not only discussed what is the meaning of adjusting event, non-adjusting event, but also I have taken up the illustrations from your exam questions. What is the treatment if it is a trade receivable? What is the treatment if it is an inventory? Okay, so now what is the treatment if it is a dividend? So all the three treatments also I have discussed, and what you will do, you will find this in the part 2 of my video, part 2 of the SBR revision, and if you go to the description of the video, you will find the time stamps. So you are not required to waste your time in that. So just click on the timestamp and watch this video, and there you will find the entire details of it. Is that clear, Vedika and everyone? If you want to understand events, so just go to that. In just 15 to 20 minutes, I have explained each and everything about events. So I have showed you the notes also. If you want to refer these notes, the SBR revision notes are already shared in the Telegram group, WhatsApp group, both. You can use that. Okay. Yes, Himanshu, it is there. Okay, or if you want, what I will do is I will include these notes. If you want, what I'll do is I will include these notes in your these notes. Close. I don't want you to put some extra efforts at this juncture now. So what I will do, see, after provisions, I am pasting these notes for you guys. Okay. See, I have pasted here itself. I have pasted here itself. Now will it be helpful? Now will it be helpful, my dear friends? Okay. Chalo. Moving on to the next chapter. Foreign exchange transactions. Foreign exchange, and this is a very wonderful question, and students do make a mistake here in this question. Generally they do make a mistake, they don't understand this part of the question. So understand, it says Mr. Company buys, okay, just to give you a surety, how many questions are left? 1, 2, only 2 questions, only 2 questions we have completed. Okay, shall I tell you one thing honestly? I want to give you, I want to do a confession. I want to make a confession. I promised you 30 questions, but in this session, I have not taken 30 questions. I have taken 31 questions. I have taken 31 questions, but it won't look good in the thumbnail. I am writing super 31 questions, right? So I wrote super 30 questions. So this is the confession which I want to make to you guys. Okay. So here we are discussing 31 questions. Okay. Now, Mr. Company buys goods priced at euro 50,000 from a Dutch company on 1st November 2008. The invoice is due for settlement in 2 equal installments on 1st December 2008 and on 1st January 2009. So basically, understand, Mr. Company buys goods here and doesn't settle the amount. It is a payable here. It is a payable here. It is a payable here. Okay. Now it pays 50% here. 50% payment is done here and 50% payment is done at the beginning of the next year. Means 50% is still due to be paid at the end of the current financial year. Now, yes, I am very chalak, Sagar. I am very chalak. Okay. Now a payable of euro 50,000. A payable of euro 50,000. So now tell me what I have to do. See, since I have run a transaction in a currency other than functional currency, so I have to convert euro to dollars. I have convert euro to dollars. Okay. So now I will give you one hint. To convert, I will give you one hint. If you are going from strong currency to weak currency, amount will increase. Always keep this in mind and you will never make a mistake. If you are going from weak currency to strong currency, weak currency to strong currency, your amount will decrease. Your amount will decrease. Your amount will decrease. So now understand this question. So here what is happening? See, 1.63 to $1. Now how to understand which currency is strong and which currency is weak? Shall I disclose the secret which I use? Do you want to know the secret which I always use to understand which currency is weak and which currency is strong? Do you want to know the secret? Come on guys, tell me. Come on guys, you guys are not active now. Come on. So the secret here is, see, on one side dollar is one standing, and on another side 1.63 euro is standing. So now to fight with $1, 1.63 euro are required. Now tell me which is who is strong? Tell me who is strong here. Tell me. $1 can fight with 1.63 euro. Who is strong? Tell me. $1 can fight with 1.63 euro. Who is strong? Dollar is strong because dollar can single-handedly manage 1.63 euros. So now what you have to do? You have to convert from euro to dollar, weak to strong. You have to convert from weak to strong. Euro to dollar. Euro to dollar means weak to strong. So your amount should decrease. Your amount should decrease. Now you yourself think, how will you decrease the amount? So if you have 50,000 euro, so to decrease the amount, what will you do? You will divide. To decrease the amount, what will you do? You will divide. So that's what you have to do. 50,000 divided by 1.63. It is 30675. Now tell me, are you understanding this point? Tell me, you got the logic how to convert? You got the logic how to convert? You got the logic how to convert? No. I don't punch anyone. You know what? I am very simple guy. I don't punch anyone. Okay. So now focus again on the class. Okay. I'm a very simple guy. I don't punch anyone except for the students who don't follow me. Okay. I don't punch anyone, yaar. Okay. Coming back to the topic. So 50,000 euro converted to dollars is $30675. $30675. Now here I am paying 25,000 euros. I am paying 25,000 euros at the rate of what? Now here the rate is 1.61. Tell me how much amount am I required to pay? 25,000 divided by 1.61 is 15527. 15528 is the what I have to pay. Now tell me, what is the carrying amount of it? What is the carrying amount of 50%? 30675 divided by 2 is 15338. But I have to pay 15528. Oh my God, I have a loss. I have to pay extra. My carrying amount of liability was this much, but I have to pay this much. So I have to pay extra how much? I have to pay extra how much? 190 is my loss, exchange loss. It goes to P&L. It is a realized loss. It is a realized exchange loss, goes to P&L. Now understand, on 31st December 2008, 25,000 euro is still pending to be paid, So now what I will do, since it is a liability, so we will revalue here, we restate here. So now tell me, what is the value of the liability? So what is the rate? 1.64. So divide 25,000 divided by 1.64 happens to be 15244. 15244 is your liability, but the carrying amount of the liability 50%, the remaining 50% which is yet to be repaid, the carrying amount of which is 15338, but the value of it as on 31st December is 15244. Means your value has decreased, your liability has decreased by how much? 94. So it is an unrealized gain. It is an unrealized gain which will go to P&L. So whether realized, unrealized, gain, loss, everything will go to P&L. Realized gain, loss, unrealized gain, loss, everything will go to P&L. Everything will go to P&L. Okay. Now, so here 94 ka gain, here 190 ka loss. So total net if you do 96 ka loss. Okay. Disa, can you give me a mnemonic? So I have already given you a mnemonic. Okay. Now, coming to the next question of earning per share. Okay. Yes. Okay. Let me give you one more thing. So we restate. Do we restate everything? No. We don't restate everything. We restate only foreign currency monetary items. Now comes the question: what is the meaning of foreign currency monetary item? Foreign currency monetary item means it is a receivable or payable in foreign currency, and the amount is fixed as per the contract, and the amount is fixed as per the contract. This is called as foreign currency monetary item. If it is a foreign currency monetary item, we need to restate. See here, understand, we purchased goods. So did we restate inventory? No. Why? Because inventory is not a receivable or payable. Okay, so it is not a foreign currency monetary item. So we are not restating inventory. Okay, inventory we recorded cost only. But now, since this is a payable in foreign currency and the amount is fixed, that is 50,000 euro. So hence we are restating this. Hence we are restating any exchange gain or loss, whether realized or unrealized, on restatement of foreign currency monetary item, it goes to P&L. It goes to P&L. Okay, now one more point. Okay, no, okay, it is required till here only. At a far level, it is required this much only. Now, earnings per share. Yes, non-monetary item like inventory, like property, plant, equipment, like intangible assets, these are non-monetary item which we don't restate. Okay, unless it is at fair value model. Now, earnings per share. Earnings per share. A wonderful question which I have taken up from BPP activity number 3. Activity number 3. So now in this question, what has happened? See, everything is there in this question. In this question, everything is there. So understand, on 1st January 2001, Saunders company had opening balance of 20 lakhs ordinary shares. So this is the opening balance. During the year, there was a fresh issue of 270,000 shares. During the year, there was a right issue. During the year, there was a bonus issue. Everything is there. Okay, now profit for the year is given. Okay, previous year earning per share is also given. Now, first of all, you have to calculate 3 things in this question: weighted average number of shares, earnings per share for the current year, and earnings per share for the previous year. So these are the 3 things which we have to find. So first of all, we'll find the weighted average number of shares. Let us find weighted average number of shares. So now the question has already given you the data for the change in the number of shares. So understand. So how will we do it? So opening is 20 lakh, which remains outstanding for over a period of how much? January, February, March, April, 4 months. So 20 lakh into 4 months. So whatever I'm highlighting, I have already explained. Okay, whatever I am highlighting means I have explained that point. Okay, whatever I am highlighting, it means I have explained that point. Now 20 lakh into 4 by 12. Okay, 20 lakh into 4 by 12. Done. Now on 30th April, I issued fresh issue of shares for 2.7 lakh. So how much shares it becomes? 22.7. So 22.7. Now for how many months? 31st July till 31st July. So how many months? Understand, May, June, July, 3 months. So into 3 by 12. Okay. Now on 31st July, I made a right issue. On 31st July, I made a rights issue of 1:10. So how many shares was there? 22.7. So how many shares I would have issued? 2.27 shares I would have issued. Right, so total shares became 24.97. Now we know that right shares means what? Shares issued at discount, means a portion of it is a bonus shares given for free. Bonus shares given for free. Bonus shares. So now whenever there is a bonus shares, we multiply with the bonus factor. We multiply all the shares prior to the bonus issue. We multiply that with the bonus factor. So now we have to calculate what is the bonus factor for this right issue. What is the bonus factor for this rights issue? Okay, so now for that we need to understand what is the bonus factor for right issue. It is fair value before right. Fair value before right divided by theoretical X right price. Fair value before right divided by theoretical X right price. So understand, let us calculate that. So what is the fair value before right? See, it will be given in the question. Fair value before right is 2.0. Okay. Sorry, pencil is discharged. I'm sorry. So fair value before right is 2.0. If you can see here, 2.0. And now what is the theoretical X right price? Theoretical X right price we calculated at 3. I believe I'm not required to again show you the calculation of TERP. I just want you to know the process of calculating the weighted average number of shares, because this is the area where you make a mistake. Okay, calculation of TERP is quite very much easy. So what is the number of shares prior to right issue? What is the fair value prior to right issue? Plus what is the right proceeds divided by total number of shares after right issue. So this is the TERP that we got. So what is the bonus factor? Fair value before right 3.1 divided by TERP 3. So it is 3.1 by 3. It is 3.1 by 3. So what we are doing here is, we for prior to right issue, whatever were the number of shares, we multiply that with the bonus factor, that is 3.1 by 3, 3.1 by 3, 3.1 by 3, 3.1 by 3. Okay, now on after right issue, the shares become how much? 24.97. 24.97. Now how many months it continues? July done, August and September 2 months. August and September 2 months. So into 2 by 12 into 2 by 12 into 2 by 12. Now understand, on 30th September we are making bonus issue. On 30th September, we are making bonus issue. Now of 1:20. So what is the bonus factor? 21/20. So we will prior to 30th September, whatever shares were existing, we will multiply that with the bonus factor. So prior to 30th September, whatever shares were existing, we'll multiply that with the bonus factor, 21/20, 21/20, 21/20. Now after bonus issue, what is the number of shares? So 24.97 divided by 20. Okay, that is 1.2485 is the number of shares that we issued as part of bonus. So my total shares become 26.2185. Now 30th September till 31st December means October, November, December, 3 months. So 26.21850 into 3 by 12 is 655,462. Is 655,462. So if you add everything, it comes to 2431507. It comes to 2431507. So this is the weighted average number of shares. 2431507 or 508, same thing. What is the earning per share? So what is the profit? 400,000 divided by 2431 508. So it comes to how much? 400,000 divided by 2431508. It comes to 16.45 cents. 16.45 cents. So 16.5 cents. Okay. Now what is the restated earning for the previous year? So what will we do? Previous year divided by the bonus factor. So what is the previous year earning per share? What is the previous year earning per share? 18.6. 18.6 divided by what is the bonus factor? What is the bonus factor that we have used in the current year? 3.1 by 3 and 21.20. 3.1 by 3 and 21 by 20. So now can we write it as 18.6 into 3 by 3.1 and into 20 by 21. So basically to calculate that, you have to take the reverse of the bonus factor. Okay, that comes to 17.1 cents. I will calculate 18.6 into 3 by 3.1 into 20 by 21. That comes to 17.1. So this is the answer. This is the answer. So this completes my super 30 questions. I believe this session would have helped you. Now the surprise part was FR theory discussion will be going to be held tomorrow again at 6 p.m. Surprise is FR theory tomorrow at 6 p.m. Tomorrow at 6 p.m. Please join the session. And super 15 questions of group accounting. I will paste the link of that in description box. Now I have one more surprise. Tell me, do you want to know? I have one more surprise for you guys. Tell me, do you want to know? I have one more surprise for you guys. Tell me, do you want to know the surprise? Come on, guys. The surprise is this session's recording will be available. The recording of this session will be available. Okay, wonderful. Thank you guys. Bye-bye. I hope you enjoyed the session, and all of you, one sincere request from all of you is once the session ends, all of you please go in the comment box and give your honest feedback, whether you like the session or not, whatever is your feedback, please give a feedback in the comment section once the session gets over. Okay. Now, if anyone needs any help, whatever might be, you can reach out to me on this number +91 85840 12637 85840 12637 +91 country code. Okay. Thank you guys. Bye bye.